and this is now minimum, is that silver will at least see 200 in the next 6 months. We're in a bull market now. We've broken out on the spread. So silver's like a surfer riding on waves. And the top wave everybody chatters about. It's just the day-to-day, ooh, they raise margins on the COMEX or this, that, or the other, all micro stuff that doesn't matter. It's the ongoing supply-demand, not whether the COMEX raised margins by 5, 10%. Yeah, we have a supply-demand deficit, and we now have demand for silver that is outpacing supply based on high-tech things, solar power for the solar panels, all the tech and AI constructions that are going on. Silver is essential in that. It's embedded in everything you touch, okay? But the underlying reality is it's money. Don't forget that. It's poor man's gold. You express the ratio of silver to gold or our percent scale of silver to gold, and you go to, 3% of 8,000 gold. Well, you put the number on it, But what if you go to 6% of 8,000 gold? Whoa. And what if gold doesn't stop at 8,000? The gold miners did the same thing versus the S&P. Silver did the same thing versus the S&P. By our metrics, not judging the silver by its own dynamics, but the silver versus gold situation, which a lot of people plot the other way, the ratio. We divide silver into gold and express the answer as a percent. And back early this year, it was down to 1% silver ounce versus an ounce of gold, which if you go back 50 years, you see times when it's that low, you buy it because it's too low in relation to gold. In the 1979 to 80 move, which everybody remembers, that's when silver went actually from, it had been in a low around $3 or $4 and went to 50 over a couple years. A lot of that compressed in the last couple quarters. In fact, a fourfold increase in the final 2 quarters of that move. And in 2001 through 2011, there was another bull market, but a lot of it was compressed in a couple quarters. In September 2010 through April 2011, where several doubled in half in 5 months. Okay. But those were within that old range of reality. It's half a century of this. Okay. You've got some charts if you want to show them, but there have been other markets that over history, rare events, admittedly, but have been stuck in price ranges. Copper's one, lead's another, we've shown to our subscribers. Back in, this is just a good historical example. Copper was stuck in a range like silver between the 1970s, 80s, 90s, 2000, and 2005. The top of that range was about $1.50. Okay. And it suddenly decided, for whatever reason, unique to itself, because it did it on its own. It was not coincident with gold. It was not coincident with other base metals. Copper quadrupled in a couple quarters. And then subsequent to that, yeah, it overshot, it's no new normality, but it moved out of the old multi-decade range and did it like bam, not in an incremental layered manner. Lead did the same thing in 2007. It had been in like a 40-year range, and it said, oh, okay, I shouldn't have been here that long. I'm priced too low relative to, let's say, degradation of the money unit. So it did the same thing. It quadrupled in a couple quarters in 2007, and then subsequently lived in a new price reality that was roughly 4 times the price level of that average old price reality. Okay. Well, silver's been in that reality for 50 years. Why didn't silver coincident with copper in 2007? Or 2005, or lead in 2007, or gold in its repeated 8-fold bull markets, goes well past the old high. And yet silver stays in the box. What's going on there? Well, there's arguments that, it's been artificially restrained and so forth. But forgetting that, when a market decides to say, hey, I made a mistake, it quite often will compensate for the mistake by repricing itself rapidly. This is true with like bull market bubble tops, like in the stock market. Sometimes it crashes, okay? It compensates for it and overdoes it. Well, silver's saying, hey, I'm out of here. And the momentum already said that back in June. We said, okay, when silver was coming up toward that mid $30 level, it'd been 35 and 35 in 2024 and 2025 early. And silver dropped down under 30 again, and it's coming back up in June of this year. And it was in the mid 30s, and we said, this time it's different. You're going to accelerate. That was a momentum-based assessment, not just that price looked good. And sure enough, it zoomed past 35 and got up, up toward the old range highs, the $50 stuff. And now we've since blown that out. But its mode of advancement has accelerated, like you noted, the year to date. Few people are cheering that. They're screaming at every downturn. The difference this time is the silver gold ratio just broke out of a massive technical basing range where silver had been caught in a box since the early, like 2022, 2023, 2024. It kept coming back up to like 1.2 something percent of gold and go back down. So you could see it on a spread chart, which we've also sent to you. And when it broke out, that was the November close. And silver then was what, 44, you said, something like that? Yeah, where we last talked. Okay. Well, look what happened since. The month of December, you went, well, I think the November price close was in the mid 50s. So we gained, 10, 20, 30% in a matter of 4 weeks. What caused that? The spread broke out. And when you go back and look at that 79 explosion to 1980, where you quadrupled in 6-7 months, or the 2010 to 11 explosion, already in a bull market, but it exploded. Those lasted a couple quarters. We just broke out into November. So this clock is very young, and people aren't understanding that something different is going on.
So you raised a couple of good points here. First of all, you talk about the money supply, and we got to talk about this. What the governments have done in the U.S. and Canada and throughout the Western world is just crazy in terms of money printing. And I just want to quantify this. In 2020, January of 2020, before all the craziness started, the money supply as measured by M2 was 15 trillion. Now it's 22.4 trillion. That's an increase of 42% in just 5 years. And
nice.
Yeah, I know. It's just crazy. And the other way of looking at this is that your purchasing power of your dollars have been cut in half, right?
Yeah.
Just in that few short years. Yeah. But having said all that, I want to go back. You mentioned a couple of times about the price of silver. It was $50 back in 1980. And I did a quick calculation on chat. And I said, if you were to bring that forward using today's dollars, what's the price? It's $190 to $200.
Okay. Yeah.
Okay. And if the other time we saw silver go to $50 was in 2010, 2011, that would be $75. So we're more or less there right now. Okay. So we get a long way to go. But let's talk about the silver gold ratio. And if you just look at that, where do you see it going? Where do you see the price of silver going here in the coming
in 50 years, going back to 75, if you plotted the highest monthly spread close of silver to gold, the monthly close during that year, that was the peak reading of the ratio, the difference between silver and gold. 20 of those years was 2% at least. 20 out of 50. So that's not like rare. In fact, a lot of those occurred in non-bull market years. But in the bull market years, 79 to 80, the tail end of those explosive moves, and 2010-11, it got up to 6.5% and just over 3%. So we're in a bull market now. We've broken out on the spread. So I don't think we're just going to 2%, which is, who cares? That's normal. But we're at least going to match the old spread highs of those prior bull markets. Heck, we've taken out the price highs of those markets. Why not the ratio highs? And I think we will. My minimum assumption, and this is now minimum, is that silver will at least see 200 in the next 6 months. Okay? Now that sounds crazy. Well, again, when you look at that copper chart, it went from like a range from 50 cents to $1.50, and all of a sudden went up to $4.50 in a couple quarters. And it was unique to copper. These kind of things happen. And I could have found 6 other markets that did the same thing over the past 50 years. Silver's doing its thing now. And we all know that this time around it has unique factors that are underlying this. But most people forget the real factor. Yeah, we have a supply demand deficit, and we now have demand for silver that is outpacing supply based on high tech things, solar power uh, for the solar panels, and also all the tech and AI constructions that are going on. Silver is essential in that. It's embedded in everything you touch. Okay, maybe a small amount, but it's an essential, and that demand is eating up the supply, and supply is not increasing despite the higher price.
The $200 call only sounds extreme if you ignore how markets reprice scarcity. Copper's historic quadrupling wasn't speculative mania. It was delayed recognition of supply constraints colliding with real demand. As Michael Oliver explains, silver today faces a documented structural deficit. Industrial demand from solar and AI hardware is rising faster than mine supply, even at higher prices. The Silver Institute has repeatedly flagged multi-year deficits, yet analysts continue to model linear price paths. That disconnect leaves investors dangerously underexposed to nonlinear outcomes. Next, Michael Oliver reveals why focusing on industrial demand alone still understates silver's true role.
So you got a unique situation there just on that industrial aspect of silver. But the underlying reality is it's money. Don't forget that. It's poor man's gold. And it's going to catch up to gold. It's going to catch up to its old relationships to gold. And in the process, that's an incredible price implication. And I think it may even challenge the spread highs we saw in 1979, 80, 6%. Again, we're 1.6 right now, okay? And take out the 2011 peak, which was 3.1, I think. So those are factors that are underlying. So silver's like a surfer riding on waves. And the top wave everybody chatters about. It's just the day-to-day, they raise margins on the COMEX or this, that, or the other, micro stuff that doesn't matter. It's the ongoing supply demand, not whether the COMEX raised margins by 5, 10%, 5, 10%, 5, 10%. That's not important. The fundamentals are still there. And then you've got the monetary factor. And that is the one that's most people still aren't appreciating, that's underlying gold and silver.
Yes, you can't forget about the money supply. So, all right. So you said you see gold or silver going to $200 in the next 6 months. What about gold?
If you go back and study silver on a logarithmic scale, not just a price chart, and gold on a logarithmic or ratio scale, and you go back to 75 when they legalized it, okay? Gold had a corrective low in 76 down near $100, 103 actually. In fact, I was standing next to the pit the day that occurred. It was in August of 73 in the COMEX. It went from $103 to $850 in 3.5 years. That's an eightfold move. Okay. And under conditions that are nowhere comparable to what's underlying the market right now in terms of massive monetary fundamentals. Then in 2011, after a 10-year run up, it had an eightfold move from $260 to $1,920. Eightfold. Oh, interesting. Okay. Now we're fourfold. Our bear market low was in 2015 at $1,050. We've gained fourfold. Okay. Yet the underlying conditions are far more serious and yet to be unveiled fully. Some people realize them. And if gold merely goes to I did it again, or another eightfold move, you'd be 8,000 plus. And even that's no big deal. So I throw that number out a lot, not because I'm predicting it. I think it's a nonsense number.
The detail most investors miss isn't the 8,000 figure. It's the historical symmetry quietly staring back at them. Gold has already completed 2 separate eightfold advances since the 1970s, each one triggered by periods of monetary stress. Today's environment makes those episodes look small by comparison. Balance sheet expansion and global debt now dwarf anything seen in prior cycles. As Michael Oliver has emphasized time and again, logarithmic charts reveal regime shifts, not hype-driven price targets. From that perspective, gold is only halfway through its previous historical template, sitting at roughly a fourfold gain since 2015. Meanwhile, global sovereign debt has surged beyond $300 trillion, a scale that simply didn't exist in 1980 or even 2011. Viewed this way, gold stops being a short-term trade and becomes portfolio insurance against a structural monetary reset. And what Michael Oliver explains next reframes silver's role within that same historical pattern.
You're going to get there and go way beyond it, especially when these underlying monetary factors become more bleeding obvious to the analysts and investors who are apparently oblivious to these factors. So 8,000 would be, so what? We did it twice before. I think gold could go way beyond that. So when you express the ratio of silver to gold, or our percent scale of silver to gold, and you go to 3% of 8,000 gold, well, you put the number on it, But what if you go to 6% of 8,000 gold? Whoa. And what if gold doesn't stop at 8,000? Whoa. And plus, you did the monetary factor there of M2. Okay, that's very interesting because it says, 200. I just matched the 1980 high. Well, when markets go from excess one way, in this case, is silver suppressed for too long, and goes to a new reality, it'll usually overshoot what should be that new reality. It overdoes itself. This is typical of market moves. So, it wouldn't shock me that if 200 is back to the 80 high, well, maybe you go to 500 before you settle back at 2 to 300. Okay? You get the point?
The uncomfortable truth is that markets don't stop at fair value. They punish disbelief through overshoot. Michael Oliver points out that silver didn't top out at equilibrium in 1980 or 2011. It exploded higher as years of suppression unwound faster than analysts could recalibrate their models. With M2 up more than 40% since 2020 and real yield still historically distorted, the idea that silver will politely stall at an inflation-adjusted high ignores basic market psychology. Analysts gravitate toward round numbers like $200 silver because they feel safe, not because history justifies them. For investors, the real risk isn't silver's volatility. It's being structurally underexposed when repricing accelerates. From here, Michael Oliver moves beyond price targets and toward a broader shift, a regime change across asset classes.
So, and a lot of it because of our spread analysis, which I think is the key factor now. And also there's some other spreads that need to be looked at that just began. And those are the asset class breakouts where gold versus the U.S. stock market measured against the NASDAQ 100 or the S&P just blew through an 11-year wide spread base where it lived in a range up and down versus the S&P, where gold would rally versus the S&P and then pull back. But net on balance, for 10, 11 years, gold was par to the S&P. People don't believe that. But you go back 10 years and gold was matching the S&P in ebbs and flows, but in a range that a kid with a crayon could draw. We broke out of that in October. That's a fresh base breakout spanning more than a decade. The gold miners did the same thing versus the S&P. Silver did the same thing versus the S&P. So these relative asset measurements tell us that monetary metals just broke out as an asset category versus the stock market. So the game just began. It's not over.
This is a line Wall Street quietly sidesteps because it undermines a stock-only portfolio story. Gold keeping pace with the S&P 500 for more than a decade, and now breaking out relative equities, signals a rotation in asset leadership, not a short-term speculative move. As Michael Oliver has shown, relative performance breakouts that follow long base structures tend to persist for years, especially when valuation gaps are stretched. With the S&P trading near 20 times forward earnings, while monetary metals sit near multi-decade relative lows, this shift materially changes long-term allocation risk. For investors, this isn't about abandoning stocks. It's about recognizing that leadership has changed.